Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Jeremy Friedman. He is the CEO and co-founder of Stoic Equity Partners. Jeremy began his career in investment banking as an institutional bond broker in Memphis, Tennessee. First as vice president of NBC Capital Markets Group, and ultimately senior vice president at Duncan Williams. Jerry worked with a variety of clients, including banks, pension funds, insurance companies, mutual funds. His primary responsibility included assisting clients with strategies to maximize returns and in their fixed income portfolios. He transacted over $1 billion of primarily NBS and CMO securities during that time with NBC and Duncan Williams. From there, did some home building and then also retail development, real estate brokerage, and now doing some syndications with Stoic Equity Partners. So, Jeremy, I can't wait to dive into your story and appreciate you being on The Wealth Flow.
Hey, it's great to be here, Keith. It's always interesting to hear my history read back to me like that. I appreciate the introduction there. So a lot of water under the bridge through those years. So it's good.
Right, I understand. It's always good, though. It's always interesting to me to kind of see people's backgrounds and, kind of what led them to where they currently are. But if we could, I kind of took us there, but if you could maybe take us there as well and just, I always like to start with where you grew up and what eventually led you to, your career choices and eventually to real estate.
So I grew up in Tuscaloosa, Alabama, small town in central Alabama. A lot of people probably know from the University of Alabama, Roll Tide. Went to school there in Alabama, met my wife at Alabama, and she was from Memphis, Tennessee. So I chased her back there after school. And that's where I got into the bond business. I was an institutional bond broker, as you mentioned. It's interesting. You don't know how things are going to turn out, but God definitely had his hand in my life through what I like to call my 3 careers of investing, construction, and real estate. And they all kind of now tie together perfectly with what we're doing at Stoic Equity Partners. But the bond business was a lot of fun. I would analyze clients' portfolios, come up with swaps and trades that made sense based on the current market conditions. As you mentioned, I specialized in mortgage backs and CMOs. It was a very interesting time to be in the bond business back in 2000. This was pre-08. Let me just preface the way, right?
Okay.
And so, it was a bull market in bonds. Everybody was buying everything. Everybody was buying a lot of risk. I tended to be very conservative with the mortgage backs that I was selling and the CMOs, but there were certainly a lot of high risk products in the market at that time, and banks and others were putting them on in their portfolios. So it was a very interesting time. And it was a weird transition into construction from there. So my NBC Capital Markets was bought out by SunTrust. My wife and I decided that we had just had our first kid and didn't want to raise a family in Memphis, didn't want to move to Atlanta either. And so we moved to this little town on the Gulf Coast, Fairhope, Alabama, to raise our family. And another firm in Memphis said, "Hey, we want you to come on board with us." That was Duncan Williams. I opened up a branch office in Fairhope, which was basically code for I had a Bloomberg in my upstairs bedroom, right? So it was a branch office. Was calling on institutional clients throughout the state. And about that time, a friend of mine who was in the home building business convinced me to get into home building, start a company with him. And I was really not intended to be in the field or do any of the. I was the office guy, the finance guy. That was it. We started that company in 2006, so you can really get an idea where that's going to go from there.
Right.
It became apparent really quickly that I needed to be more involved, and that my partner didn't quite have the depth of understanding of that market that I thought he did, and I had to protect my investment and get in there and get in the field. And so through 06 is really when the housing market peaked. It didn't really show up to the rest of the world until 2008. But we really had impeccable market timing, got in at absolutely the top of the market. And it was painful, pivoted all sorts of ways. I pivoted from production home building to more of a custom and semi-custom home building, pivoted to some high performance and green certified, built the first NAHB green certified homes in the state of Alabama. Was able to through all that. And then we had a little thing down here on the Gulf Coast called the BP oil spill in 2010, which kind of put the final nail in the coffin. And I finally just said, I can't do this anymore, and went to work in 2011 for a retail real estate developer doing single tenant net lease retail properties, mainly in dispositions for them. So I was selling a lot of retail, which was interesting. It's credit and cash flow. So it's a lot like bonds. It's a lot of similarities there. Really took to that and enjoyed that market. Left him eventually to get out on my own and have a brokerage called Catapult Properties. We do stuff around the Southeast. And then one of my friends from the brokerage world, and I had always wanted to get on the principal side of things. And in 2020, when COVID hit, we said, "Hey, the phones quit ringing for about 30 days, gave us enough time to hatch a plan for Stoic Equity Partners," which we did. Started doing deals, our first 4 deals in self-storage. And we did an adaptive reuse of an old grocery store box to climate control self-storage. We bought a fully stabilized kind of core plus property. We bought one that we expanded, tripled the size of, and did a ground up development. And then we really had a hard time making that market work and pivoted over to the multi-tenant value add flex industrial properties, which is where we live today. So it's interesting how, so a lot of what I do is dealing with the investment side of things. It's dealing with the construction for our renovation projects, and it's dealing with obviously the real estate. So it's interesting how they all come together like that.
Yeah. And what do you think, in those various asset classes, what are some of the differences that that you've seen just in the ones that you've been in? Whether it be the single tenant retail stuff before you started kind of syndicating and stuff, on up to some of these other ones that you're in now. What are some of the differences?
So what we really like about the multi-tenant flex and also to some degree self-storage, we like that multiple occupancy. We think it gives us a lot of protection for vacancy risk. All of our eggs aren't in one basket, so to speak. If somebody we constantly have tenants moving in and out, and it's just not a problem. Matter of fact, it gives us a lot of times opportunity to reprice to current market rents in the market. So we single tenant retail, it's a fantastic credit play. But typically you're dealing with pretty long periods of flat leases. So maybe one increase every 5 years. But if that, I mean, there's some of the tenants that are signing, 15-year flat leases, and the drugstores even longer than that, 25-year flat leases. So you don't have the increase in rents. And then when and if and it's really a win. There's no property out there that the tenants never leave. I mean, there are a few people. Sherwin-Williams likes to stick around. It's not unordinary to see a 60-year tenancy in one of their properties. But when people move out, then you're dealing with a vacancy for a whole property. You got a lot of carry cost. So we really like the cash flows that are associated with multiple tenancy for the vacancy risk mitigation, as well as being able to reprice. We typically are able to negotiate annual increases in our rents. So we really like that. But the biggest thing we love about flex industrial properties is supply and demand. There's a huge imbalance there. There's been no real new supply of flex industrial over the last 30 years. And currently, we're dealing with rental rates of $8 to $12 a square foot. And you just really can't build it for that. So, and make your numbers where construction costs are. So we feel like we've got a lot of insulation protecting us from new supply, and, talking out of both sides of my mouth here, and once someone does, because supply is so low and demand is so high, when someone does start to build, they'll have to achieve higher rates to make that work. And that helps bring our rates up some more. So we buy value add stuff. So we're looking to increase rates and or occupancy on everything we do. Another thing we love about it, it's kind of, there's a lot of legacy owners that have put off deferred maintenance and they're not real aggressive on pushing rents. They let the same tenants stay there forever at low rents. So we're able to get in there. We may have some deferred maintenance to do. We underwrite that on the front end, but then we're able to bring those rents up to market. So we've been able to see a heavy lift in rents and occupancy just by doing some pretty basic deferred maintenance type improvements. So,
okay. And tell us a little bit more about this type of property. So who are the tenants typically in this? Is this a lot of visibility from the street? Are these kind of in industrial parks, or what? Tell us a little bit more about what type of tenant and what kind of consumer shops there.
Yeah, it's good questions. So first of all, let me clarify, flex industrial is maybe some industry jargon for some people don't understand it. I mean, what we're talking about here is office warehouse parks, right? So you've got, we like to call it the mullet of commercial real estate. So we've got office or maybe showroom on the front of the building. So And then out back, you've got roll ups and dock high doors and the warehouses. So, to a little more color, we're dealing with 50,000 to say 150,000 square foot properties. And we're dealing with suites that, I'd say on average are 3,000 to 5,000 square feet. We obviously have some smaller than that, some larger than that, but that's kind of the sweet spot. So what we've got is a very broad, it's very flexible, i.e. flex industrial, but we've got a really wide range of types of tenants. But the types of tenants that are drawn mostly are, service company, HVAC, repair companies, engineering companies, right? Terminex is in several of our facilities. IC, just companies that need repair companies. We have a couple of elevator repair companies. They need somewhere. They have some office. They need somewhere to keep some materials in the back, somewhere for their service techs to come in and gather and then go out. We've got several last mile logistics companies, FedEx and JB Hunt. We've got some life sciences stuff. We've got some labs. We've got some pharmacies. It's a little bit of everything, really. And then because we are kind of the low cost provider for space around, sometimes we'll get hair salons or nail salons that will also look to locate there. We try to stay away from heavy office build out, or we like to find properties that have a heavy office build out that are low occupancy, because we know the market's looking for 50-50 office warehouse, or maybe even as low as 20% office. And what you get is you get a lot of these owners that have had this property, and back in the, say, early 2000s, office space was more desirable, brought in more rent. They have these things that are built out 80-90% office. It's a sunk cost to them. They're still stuck in the thought of, oh, this is more valuable than the warehouse space, but the market's looking for warehouse space. So we go in there, and that's one of the biggest value add lifts we do, is we come in and we whack out about half of the office space and lease it up almost immediately. So, we do like centers that have some retail facing, because it gives us some more flexibility for some of those tenants that actually want to interface with the public. We have some that are often some office parks and business parks as well. So it's just kind of a bit of mix of everything. So, very flexible.
Right. Yeah. And typically, what are you seeing on those? You mentioned some of the value adds that you can do, and obviously converting the office space. What are some of the other levers that you can pull to kind of increase that net operating income?
So not unlike a value add multifamily property might come in and put some new flooring, some new paint, new countertops. We do a lot of that, freshen up the office space, come in with some LVT flooring and new paint, new countertops, freshen up the bathrooms, and that goes a long way. Sometimes we have to do as much as, say, new roofs, which can get very expensive when you're talking about 50 to 150,000 square feet. And normally we're talking about flat roofs, TPO type roofs, going from a membrane to a TPO roof, that kind of thing. Sometimes we've had to kind of spruce up the facades, redo some stucco. We oftentimes have to reseal and stripe parking lots, refresh landscaping, deal with, little issues here and there that the previous owners have neglected. So that's a lot of it.
Okay. And most of the ones that you're purchasing are existing facilities that just maybe have that deferred maintenance. They've been owned by somebody for X amount of time, and like you said, in some cases they haven't kept up or wanted to push the tenants' rent up all that much, probably in an effort to kind of keep it occupied and not drive the folks out, but there's opportunity for you to be able to do that, and give a solid return for your investors.
Yeah. So a lot of these legacy owners, they to do maintenance or to do repairs or to do tenant improvements, especially, a lot of the maintenance and all could be passed through in CAM because these are triple net leases, which is another differentiator we like between these properties and self-storage, which are gross leases, dealing with the insurance rates that have gone up. And, at least we can pass that through in the form of a CAM to our tenants. But a lot of that deferred maintenance, we don't understand why they don't do it because they have the right to pass those expenses through to the tenants. But the interior, say, tenant improvements, that's something they would have to pull out of cash flow. They're not going to get it back in CAM. And so they're very often, a lot of times these owners are living off that cash flow. They don't want to pull out cash flow. So what we found is that we have a tenant come along and they said, well, we love the space, but we want you to do X, Y, Z, to get it ready for us. And, we'll either give them an allowance, let them do it, or we'll spend the monies to do it in a lot of cases. And what we found is that actually gets us a stickier tenant and usually a higher rental rate because now, hey, if this is the rate for it as is, and you want these done, this is the new rate. And so it helps us boost our revenues and boost our NOI, boost our return. And we underwrite for that on the front end. So when we buy a property, we'll typically put into reserve at least the first couple of years of tenant improvements, leasing commissions, and all of these deferred maintenance or renovation works that we've talked about. We'll put that we'll reserve all that up front. So we're not pulling them out of cash flow as we go along. We're not haven't yet ever had to go back for, capital call. So, we'll pull all that. We'll reserve all that annually. We'll reserve for taxes, insurance, and capital expenses. Pretty typical stuff. But we do reserve that tenant improvement money up front, and that helps us boost our NOI long term. So it's really a win-win for us.
Yeah, for sure. Yeah, it's interesting. I've talked to quite a few folks on the industrial flex, and it's weird to me to hear that there's some variances between some people. Some people it's gross rent versus triple net. Other folks, they're taking gross rent and converting it to triple net, or it already is being operated as a triple net. Can you maybe explain to the audience, kind of what those differences are, and what a triple net is as opposed to like a gross rent, and why you prefer the triple net?
Yeah, definitely. So, I'd say most leases in this world are either modified gross or triple net, which really a modified triple net. But a modified gross lease is a lease where taxes, insurance, and a lot of the maintenance is done by the landlord. So the tenant has to pay for their own utilities, and there's usually some maintenance that the tenant has to pay for as well. Their interior maintenance and that sort of thing. The challenge with that is if property taxes go up, or if insurance goes up, which is everybody's insurance is going up, then the landlord's net income from that property is decreased by those increases of expenses. Also, utilities, landscaping expenses, that we've seen a lot of inflation. A triple net, or really it's more of a modified triple net, because the landlord does continue to maintain things like the roof and the foundation and the structure and all, but all of the other objects, so property taxes, insurance, parking lot maintenance, landscape maintenance, landscape utilities for the common areas, all the garbage disposal. All these things are expenses that the landlord then turns around and bills the tenants on a pro rata share based on what percentage of the GLA or the gross leasable area of the property, whatever percentage of the property that they are leasing, they get that percentage of all of those expenses. So we like that as a landlord because we can bill back those increases, in property taxes, insurance, and all of the common area maintenance. The challenge is, though, that still limits, because these tenants are looking at their total cost of lease to lease this property. That limits how much we can increase the base rent. So we still try very hard to keep all those common area expenses low for the tenants. So we have a couple of gross lease properties. We have a couple that we started with gross leases and we're transferring over to net leases as we re-tenant the spaces. And then we have the majority of our industrial properties are net leases. I will say, interestingly enough, on a gross lease property these days, when we've gone back and said, hey, we need to increase your rent by 50% or some large number, their initial response is, wow, that's a lot. And then we say, hey, don't forget, our property tax bill, our utilities and landscape and insurance bills have all increased. And they go, oh yeah, okay. And they just sign it. It's pretty, it's pretty evident. They understand our expenses have increased. So, that's one only advantage to the gross leases out there. We've not had a problem increasing the rents that much, but so
yeah, it makes sense. And you saw that across your portfolio with insurance rates. I guess maybe I should ask, Jeremy, where all are you invested? I don't know if this is up to date, but it sounds like you've got nine industrial properties in the Southeast, as well as some self-storage. Where all are you, I guess, invested?
And that is up to date. We currently have 9 industrial, 4 storage. Totals, to put in perspective, about 87 million total asset value.
Okay.
And we're in Little Rock, Arkansas. We're in Jackson, Mississippi. We're in Pensacola, Florida, Mobile, Alabama, outskirts of Atlanta, Louisville, Kentucky. So what we call the SEC region. So we're on the Southeast, typically secondary cities. We just can't make cash flow numbers work in Charlotte or in Nashville, but we can in these good, solid secondary cities throughout the Southeast, where population's increasing. So again, increasing that demand, and supply is still rates are too low to be able to continue to increase supply. So that's where we like to live. And by living in those areas and dealing with those areas, we can increase cash flow. And that's a big part of our investments. So we distribute quarterly cash flow to all our investors. And then, by building up and adding value over the whole period and then selling, we'll, return a nice pop at the end as well. So,
okay. And how long are you typically trying to hold these properties for? Is there kind of a game plan to sell at some point, or to refinance and, kind of cash out some of the investors, or what does that look like?
Our industrial investments are a 5-year-old period. So,
okay.
You can't make everybody happy. We have some investors that are like, well, they're doing great. Why don't we just hold them forever? Some investors are like, hey, turn my money faster. So, but we've found that about 5 years is the right spot where we can get in there. It takes a couple of years. This isn't like a multifamily where you've got a 1-year lease, or self-storage where you've got a 30-day lease. We tend to buy these things. They have a 1.5 to 2.5 year WALT or weighted average lease term. So it takes us a little time to turn over the rents. And then it gives us a couple of years for those 3% or 4% annual increases to kick in as well. In about 5 years, it's fully baked and ready to be sold. And so most all of our industrial stuff's a 5-year hold. We have a couple of 10-year hold properties, and then on like that self-storage development deal where it's basically build it, stabilize it, sell it. That's a 3-year hold property. But and the 10-year hold stuff is primarily driven by the financing. It's a CMBS loan with high prepayment penalties. So that's kind of where we live. But the current, as of right now, everything we're doing is a 5-year hold at the moment.
Okay. And what about the financing on these flex spaces? What type of lending are you able to achieve? And from a debt standpoint, how much loan compared to the value of the property?
So we're getting anywhere from say 60% up to 75% on a LTC basis. And that's going to include the acquisition and the renovation works and some reserves and all that. So we have a combination of, it depends on what the particulars of each property. When they're more stabilized, we have an opportunity to go to, let me put this, we have one life insurance, life co loan. We have 2 CMBS loans. But a lot of the heavier value add lift type properties, they're not interested in. We like those loans. We can get a good rate and they're non-recourse. They're great. Matter of fact, we just originated a life co loan about a month and a half ago at a 5.85 rate. So we love that. But it was a very nice, stabilized property that they don't all fit their buy box, right? So, the rest of them are all community and regional banks. And so it just kind of depends again. And then when you get into those loans, get into those properties, it's, this bank likes this region or this market. This bank likes this type of property a little better than the other. So it's a lot of different lenders, unfortunately. So.
Yeah, I understand. Well, that's neat. And so you're looking at, you mentioned population growth. Tell us maybe a little bit as to what you're looking for, from a growth standpoint in the areas that you're purchasing.
Okay. So it depends a little bit on the size or the maturity of the market. So some of this Gulf Coast area down here, we may be looking for as much as 2+ % a year of population growth. But typically we're kind of starting at a lower overall population in those areas, right? So, whereas if you go to, say, Jackson, Mississippi, you're not going to find any of the submarkets around Jackson growing quite that fast. But in those areas, we're looking for the submarket that's growing 1.5% a year. Good solid growth. And on that, that's where we try to locate. So not to pick on Jackson, Mississippi. We love Jackson. Matter of fact, several properties there, and they've been really good performing properties. But inside the city limits of Jackson is not doing very well at the moment. But around the outskirts, there's several pockets of growth. And that's where we like to be. Again, back to the growth. And we look at 1, 3, and 5 mile for population growth, for, the average household income and average housing prices as well. So that's a lot of the people working at and or owning these service-based companies. They live in those suburbs. We try to be convenient to them, also convenient to transit or to transportation. So we'll be near the interstate. but also near the higher growth submarkets.
Okay. And how are you going about finding some of the properties? Is it primarily brokers, or are you marketing directly to some of the owners, or what does that look like for your team?
It is, we do a little bit of direct calling, some direct mail to property owners. However, this is a pretty specialized product, and in every market we play in, there is one, maybe two brokers or brokerage groups that specialize and do a really good job with this type of product. So what we found is most effective is we go to those brokers. We're building a broker network in all the markets that we want to own properties in. And we go to those brokers, we'll database the market. We'll say, hey, these are the properties in your market we're interested in. If you get us a shot, we'll write an offer on them. And what we found is they already know the owners of these properties. A lot of times they may have sold them this property, or they have certainly leased space in their property, and they can pick up the phone and then call Bob. Bob will answer the phone immediately, and he'll say, hey, we're, got these guys, and they're them vouching for us or letting them know we're legit, and gets immediate credibility. We get a shot at it.
Yeah.
We call Bob direct. It's going to take us 3 months to get Bob on the phone the first time. He's going to shoot us down, hang up, cuss at us, whatever. A year from now, we might make Bob comfortable enough for him to possibly consider selling us his property. We get these calls. We know what it's like. I mean, we get, get calls all the time. So we are big believers, and obviously my partner Barry and I are both brokers. We do believe in the broker network, and it's done very well for us. Most of the properties we buy are off market, but through brokers.
Mm-hmm.
Then they get to be the brokers that manage it and lease it for us. So we use third-party management in every market. That's our boots on the ground. That's our local market intel. It's very important. They manage it for us. Now, in-house, we have an asset management team, in-house accountants that manage those managers. But we use third-party management in every market. So that's another incentive. These guys could sell us or, broker properties to us. They know they can retain management, and they can retain leasing and maybe sell it for us one day. So it's working very well. We've got several markets with really good relationships that are starting to pay off, and building more relationships as we speak.
Okay. And then as you're looking at these properties and continuing to buy them, have you had any that you had certain surprises, or maybe there's something different that you weren't expecting when it comes to these, or any of those kind of stories as you've kind of acquired properties along the way?
Oh yeah. I mean, we always laugh. There's real estate. There's no such thing as passive real estate investments. There's
Right.
such thing as passively investing in real estate, but that's because you got people like us, taking care of it. But I mean, I'm trying to think of some of the most interesting ones. I mean, it's stuff like you go through the whole process of negotiating a lease and bidding out construction for tenant renovations, and then you get in there and you start tearing out walls, and there's a column in the middle of what's supposed to be the focal point conference room for the whole property. So now you're pivoting, trying to figure out, okay, well, do we somehow figure out a way to bridge that column with new columns? Do we redesign the footprint? And what do we do with the tenant in the meantime? It just becomes it just becomes a drill. We named our company Stoic. We truly believe that if anything's ever going to come up, and it's going to come up in a real estate transaction, and
For sure.
you can't control that. but you can control your reaction to it. So that particular example, we were able to deepen our relationship with the tenant, take care of the situation, redesign the space, build it out. And in the meantime, they signed a lease at a higher rent. They increased their rent because of the work and re-extended the term of their lease. So it kind of turned out okay, but it was a pretty gruesome process. There's that. I mean, there's always little expenses that pop up that are not on the sellers. You're not aware of when you first buy it. We've learned to put plenty of contingency in our operating budgets because of that. There's trying to think of some good ones. We had a space. This is terrible. We had a space that it was vacant when we bought it. We had two different contractors work on it and a new roof installed on the building. And then the tenant moves in and everything's wonderful. It gets to wintertime and all of a sudden the tenant is in the hospital for carbon monoxide poisoning. And the vent pipe had, through the vacancy period, or two contractors or the roof had gone over the where the vent was supposed to go. We had a plumber inspected the gas lines. The gas company came out to light the pilot light. Nobody caught that this vent was gone. And so, I mean, that's a terrible example of the kind of things that can come up. I mean, again, we immediately, and thank God they were fine. There was two of them affected. They were both fine, had to go to the hospital, get some oxygen, and everything was okay. But I think the way we handled the situation and how we jumped on it, got everything fixed, made sure their medical bills were paid and everything. We feel like we were able to deepen the relationship with them. But those are a couple of odd examples, but it's real estate.
Yeah, for sure. There's always curveballs. What about like with, when you're doing due diligence, I just thinking industrial, and just some of the chemicals and different things people use. Are you typically, have you ran across any that, something comes up in the phase one and got to get the phase two and then, something that, prevents a deal from going through? Or is it not been quite as much of that as maybe one would expect when it comes to industrial?
We've been pretty blessed. We certainly get a phase one ESA on every property. We do have to, occasionally we'll get a loan document or a loan commitment that says something about, we certify there's no hazardous materials on site. We have to always kind of qualify that with no improperly stored or used hazardous materials, because it's important to note, these people are, there's hazardous materials under your kitchen sink if they're improperly used or improperly stored. And a lot of these, to call names, with Terminex, for instance, they have some what's considered hazardous materials. Other of our tenants do too, but we make very sure that they're stored properly. Terminex, for instance, does an excellent job with containment units, so it's all stored very properly. We have not had a situation that required a phase two on any of these properties that Stoic has bought, or we haven't had to kill a deal over an environmental issue either. So that day will come. We're very sure of it. We have a dry cleaner in one of our properties, but it is a green certified dry cleaner, and all their chemicals, although you're not going to want to drink them, but they're not something that we have a concern about a release of those chemicals like you do some of those traditional, perchloroethylene type dry cleaner chemicals. So,
yeah.
So far, so good. I'm certain the day is going to come where we're going to have to kill a deal over environmental issue, and best to kill it before you buy it, right? What we tend to run into more is there's just roof needs replaced, and it's a $500,000 roof, and we can't make the numbers work anymore. We've had that one a couple of times. So
Okay. Yeah, that makes sense.
But most of these companies, nowadays, unless there's some historical release that happened on the property years ago, I mean, most of these companies are pretty heavily regulated, and they're doing everything correctly now. We're not seeing anything yet that I'm having a problem with.
Okay. And what about kind of where do you see Stoic Equity Partners going, 3 years, 5 years, 10 years out from now? Do you think you're going to continue to focus on that same space, or what is your vision for where your company's going?
So, much like my days in the bond business, when we would take a portfolio of an insurance company or a bank, and I would analyze and maybe say, hey, come up with swap strategies or trading strategies based on, hey, this sector is overheated. Let's sell it. Let's go enter this Let's go buy these bonds. You can buy them at a relative discount. Because of that, we have always felt like Stoic would be a portfolio manager of sorts for commercial real estate investments. With that being said, I mean, we're 100% all in at the moment on flex multi-tenant value add flex. Now, we are working already for development of multi-tenant flex, because just as we understand that you can't really develop it today and make numbers work, we also see that supply and demand imbalance is so great that day will come, and we are already working on some plans to try to be able to take advantage of that. We feel like we're in a unique position to see that situation, maybe more so than a lot of folks. So there's that. And, at some point though, it's going to be a hold scenario on flex industrial, or it's going to be a sell scenario on flex industrial. And what we see, while I know investors like to see funds or managers that are so specialized on one thing and they've got that market knowledge, what we've also seen, and right now is a great example of it, there's a lot of multifamily developers sitting out there on their hands. And, if I'm an investor, I don't want a multifamily, somebody that's only this one asset class, and they're either only developing or only acquiring value add, or, they're so narrow in their focus. I'm concerned that they are just trying to get a deal done, regardless of, is it really the right time to buy or develop this property? So I guess let me put it this way. For instance, self-storage, it's not time to buy any more self-storage. I also don't think it's quite time to sell it right now. But we'll be a seller of that portfolio, or we'll be adding to that portfolio if that opportunity comes up. So, and then same with the flex. I mean, we do not see that opportunity going away anytime soon, or that market correcting to the point where it's not the right asset to continue to go into. If we do go into another vertical, it will be well thought out and with a team that specializes that. So that's to fix that, or to fix that situation where we know, so that investors can be comfortable that, hey, I'm investing with somebody who really understands this market and this product.
Yeah, that makes sense. So you kind of don't foresee any changes coming up in the future necessarily with flex industrial, but at least are willing to be agile enough to make adjustments and stuff if it looks like it needs to be changed so that you're not feeling like you have to do a deal. So that's good.
We believe, so self-storage did very well through the '08 recession, GFC time period. And after that, a lot of institutional money started chasing it. It really changed that market tremendously to the point where now it made sense to develop huge, huge development over the last decade. That interest from institutional money and that expansion in that market has been an incredible run for the last, let's just call it a decade or 12 years or so. We really believe that's what's about to happen in flex industrial. So we really feel like, I will say, more and more people are talking to us about it, more and more interest from larger check writing investors. And we feel like we're not really early, unfortunately, but we feel like we're still on the early end of that wave. And so, I guess to put it in perspective, we feel like it will get to it similarly. It will get to the point where development is the right phase. The market will be in the right phase for development. We want to be able to take advantage of that. And then, we want to exit when the time is right. And so, that's kind of where we see it. We see flat.
Okay. Yeah, I've noticed a couple of my friends in the multifamily space have gotten into, I've seen some of their most recent offerings being, some of the flex industrial. And so I know it's catching the eye of several, other sponsors, and seeing some people kind of bridge out to that. But that's great. You've got a ton of experience with it already, and it, looks like you've got it kind of dialed in as to what to do in these, with these spaces. So it's been an interesting conversation. Jeremy, if you could maybe tell the audience, how they could find out more about you, if they're interested in investing with Stoic Equity Partners, how do they reach you?
Yeah. So I'm pretty easy to find. Stoic Equity Partners website is stoicep.com. That's STOICEP.com. And my email is jfriedman@stoicep.com. I'm also on LinkedIn a good bit, easy way to catch me there as well. And so we'd love for anybody to reach out. As you can tell, I love talking about this stuff. You can't hardly shut me up. So anybody that wants to reach out, I'd be glad to talk to them about it. So
awesome. No, that sounds good. We appreciate it. And I've got just two more questions for you, Jeremy, that I ask every guest. And one of them would just be, any advice you would give somebody who's maybe just starting out in their investment journey.
So, for me, what really helps is to, and I guess would be my advice, is to really think through macro trends as best as you can. One thing we look at a lot and talk about a lot here, and we're obviously always looking at interest rates due to debt, but we like to look at them on a much larger scale. We like to say, okay, well, when was the last time interest rates were at zero? Well, that was during the Great Depression. Well, what happened then? We had, World War II, we had inflation, we had a 40-year cycle where rates were rising. And what happened then? Inflation, which was, hard on a lot of assets, but fixed assets, real estate, that was a pretty good asset to hold through those periods. What do we think will happen if rents, as interest rates continue to go up? Rents will continue to rise. So then you had at the end of that 40-year cycle in the 80s, you had super high interest rates. What happened? Bull market, and another 40-year cycle down to, zero interest rates again. And it may not be good news to many people, but I believe that essentially we're on another 40-year cycle of up rates, and it started very similarly the way it did in the 40s with inflation. And now I don't think it's going to be straight up. It's going to do this. There's going to be peaks and valleys on the way up, but essentially we're in a long-term cycle. Other macro trends to think about is net migration of people moving out of what areas are people moving out of and moving into. That helps you understand where future demand is going to be. Looking at the trends of online retailing, or you just kind of looking at the macro trends is and really think through the implications of those trends. That would be my advice.
Yeah, no, I think that's great advice. And then how about book recommendation? Anything you've read recently that's been impactful?
Well, I'll tell you what, I'm gonna throw one out there. And I'm trying really hard to remember the author's name. But it's called Investing in Private Equity Real Estate. You probably know the book. It's like blue and gold. And I'll have to remember, I'll shoot you an email with the author's name, because I definitely want to give him credit, because it is the most thorough and easy to read accounting of how that market works. And it's written from an investor's point of view. And so I think it's really helpful. I've given that to given it out to a lot of investors, to the point where the copy I usually keep here is not here right now, or I would know the author's name. But it's a really good description of all the different types of ways private equity real estate gets done, the different markets, how to determine if a sponsor is somebody to do business with. It's a great book.
Okay. Yeah, great. I was trying to see if I could maybe find it. What'd you say the title was? Say it one more time.
Investing in Real Estate Private Equity. So I had that backwards originally. I said private equity real estate. Investing in Real Estate Private Equity. The subtitle is An Insider's Guide to Real Estate Partnerships, Funds, Joint Ventures, and Crowdfunding. And it's by Sean, that's Sean Cook. It's a great book. My son, who's a sophomore in college, has read it. And so we can have interesting conversations, and it gets into detail about how we're structuring deals or the capital stack in our deals. It's a lot of fun. So
that's great.
Yeah.
I haven't had that one recommended, Jeremy, but that sounds like my next book. So I appreciate it.
Yeah, no, I highly recommend it. So, and Keith, I really appreciate you having me on today. It's been a lot of fun. As you can again, I'm just a real estate nerd that loves to talk about this stuff.
Absolutely. No, I really enjoyed our conversation. All right, Jeremy, I think we'll call it a show. Appreciate you.
All right. Thanks a lot. Appreciate it.
Thanks.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.